In today's fast-paced world, it's easy to overlook the importance of saving. We're constantly bombarded with messages urging us to spend and consume. But what about our future selves? This is where the power of saving and investing comes into play. Saving isn't just about stashing money away, it's about building a secure financial future. To truly grow your wealth, you need to invest. Investing your savings allows your money to work for you. The key to successful investing is to start early and stay consistent. One of the easiest ways to start investing is through a systematic investment plan, or SIP. A systematic investment plan, or SIP, is a simple yet powerful strategy that allows you to invest small amounts regularly. Think of it as an automated savings plan for your investments. With an SIP, you choose an investment scheme that aligns with your financial goals and risk tolerance. You then decide on a fixed amount to invest at regular intervals, such as monthly or quarterly. This automated approach ensures you stay invested consistently, regardless of market conditions. SIPs are flexible, allowing you to start with a small amount and increase it as your income grows. Whether you're a seasoned investor or just starting, SIPs offer a convenient way to build wealth over the long term. One key benefit of SIPs is the power of dollar cost averaging, DCA. DCA involves investing a fixed amount at regular intervals, regardless of the asset's price. By investing consistently, you buy more units when prices are low and fewer when prices are high. This approach averages out the cost of your investment over time, potentially reducing your overall risk. DCA helps smooth out market volatility, making it easier to invest in uncertain times. SIPs offer numerous benefits for both seasoned and novice investors. SIPs make investing accessible to everyone, regardless of income level. SIPs automate your investments, ensuring you stay invested consistently. Regular investing through an SIP benefits from compounding, where your earnings generate more earnings. DCA helps average out your investment cost over time, reducing risk and enhancing returns. SIPs are designed for long-term wealth creation, giving your investments time to grow. By investing consistently over a long period, you can potentially outperform other investment avenues. SIPs unlock financial freedom, one investment at a time. While SIPs offer numerous advantages, it's essential to be aware of potential drawbacks. SIPs require a long-term commitment, typically 5 to 10 years or longer. SIPs don't eliminate market risk entirely. Your investments can still lose value in a downturn. The success of your SIP depends on the performance of the underlying investment. SIPs offer flexibility, but it's crucial to maintain discipline and avoid frequent changes. SIPs come with fees and charges, such as expense ratios and exit loads. It's important to factor in these costs when evaluating potential returns. Weigh these considerations carefully before diving into SIPs. When it comes to investing, you'll often come across two primary approaches: SIPs and lump sum investments. Both strategies have their own merits and demerits. SIPs involve investing fixed amounts at regular intervals, offering benefits like rupee cost averaging and disciplined investing. Lump sum investments involve investing a large sum at once, potentially offering higher returns if timed right. SIPs are excellent for risk-averse investors or those just starting. Lump sum investments are better suited for seasoned investors with a higher risk tolerance. The best approach is a balanced strategy, incorporating both SIPs and lump sum investments. Remember, investing is a marathon, not a sprint, and choosing the right strategy can make all the difference.